You're listening to The Wealth Advocates with finance experts John Mickelson and Patrick Jenkins. The Wealth Advocates simplify the financial world and show you how today's events could affect your financial health so you feel confident about your financial future.
Welcome, Wealth Advocates Nation, to our third podcast. We've had some good conversations so far. A little bit about what the market did last year. That was podcast number one. A projection on what this year looks like. That was podcast number two. We were fortunate to have an economist with us and analyze details and numbers. This, I hope, is a lot more conversational, a lot more intuitive as well. We're going to talk about where we're at in the market today. Today, we're actually starting earnings season, looking back at quarter one. And as we begin earnings season, while we're recording this, we're coming into play with a lot of different elements. The first is the flattening of the COVID graph means that maybe we're at the tail end of the sickness element of it. But we're at phase two of the whole COVID cycle, which is the financial element of it. Perfect timing to start into what today's conversation is, more about the psychology of investing. Investing is an emotional thing. Money is an emotional thing. John, why don't you lead us off? Tell us a little bit about fear and greed in investing and where emotion comes into play there.
Well, and I think that what you led in with the virus and all that it's doing to our economy right now, having everything shut down, and then the question of, when does that subside and when do we have the opportunity to restart things again? We spent a lot of time with Robert last time talking about both the monetary policy as well as fiscal policy and the stimulus in both areas. And I think that's very important in both good and bad ways. But I don't think any of that really makes a big difference until we see the human health element subside, meaning that no one cares about all that stuff until we see the number of cases decreasing and the number of deaths decreasing. That will take away a lot of the fear. And so that's a big part of where we are right now. And that's the philosophy behind this discussion is so much of what we do is based on, we think we're more logical, but the reality is we are a lot more human and a lot more emotional than we think we are. So, with where we are in the current market, a big part of this is trying to temper the fear and the concern. I mean, everything to this point, if you think about it, we're just starting earnings season right now. To this point, we've seen the market drop dramatically. It's probably down. I mean, and it's made a little bit of a rebound the last week or so, but we're down, anywhere from 15 to 25%, depending on which index you're looking at, and maybe even a little bit more if we go to the more aggressive stuff. That said, we look at where the economy's gone to this point. What is it based on? Fear and emotion, right? I mean, is there any core data out yet? I mean, almost everything we've got so far is just speculation. So earnings season is going to be the real starting point to say, are there hard numbers that support how far we've dropped? So that's a big question mark going into the next few weeks is, with us dropping 25% or thereabouts, is that too high? Is it too low? Or is it about right? And then the real numbers are going to come in and I think it will equilibrate back to where it's supposed to be.
Once upon a time, this was tax day. We're recording on April 15th. And so when you hear this, I don't know what day it will be. But as of this moment, March 23rd was our low point in this cycle. It actually blew past the December 24th, 2018 low point. Otherwise, we've been in this bull trajectory where everything seems to go up over time. That's an easy time to invest in. Index fees are very in vogue when the market's going up. Overweighting makes a little bit of difference. Overweighting not meaning my waistline, but maybe more stocks, what stocks we purchase. When you're going down precipitously, free fall in the stock market, like what we saw from, call it February 21 down to March 23, unknown everywhere. Couple that, not just you're getting poorer, but you might be getting sicker. What are clients saying to you right now?
Well, I think a lot of them are concerned about, is this going to rebound? And we lose perspective. I mean, the reality is, are companies going to go bankrupt? Some might, But the vast majority, you have to look at it and say, okay, do I fundamentally believe a couple of things? Do I believe, despite what happens in the next 2 to 3 years, people are going to buy groceries? They are going to go on, an occasional trip, maybe less now. Are they going to fill their cars with gas? Are they going to go to work? Yeah, as long as you believe those things are going to be true, the cycles will continue. And I would remind everyone, we will see a rebound and we will see another crash in the future. Those are things we know for sure. But, some of the things we should remember are, despite the ups and the ups are dramatically higher than the downs. And so we want to play those odds. And again, taking the emotion out of it is a big part. I had someone call today and was emotional about, I should have got in. And yesterday we jump in, and today was not a big surprise. It was worse than they thought. So I think in part we have to kind of take that out of it. And just like you said, you don't do your own surgery. When that's kind of our role, is to say, take a broader look at things and say, right now, for example, one of the discussion points I'm trying to be consistent about is saying, as clients come in and talk to about their accounts, first of all, number one is, has your risk tolerance changed? Now, your risk tolerance is how comfortable you are with cycles, up and down, the volatility. Now, if you could take the emotion out of it, that's a hard thing to do. When the markets are way up, like you alluded to, everybody is more comfortable being aggressive. When the markets are down, they're going to lean towards being more conservative. And that is opposite what you should do. You should be completely the opposite. However, in assigning, how I feel about risk, my own personal perspective, it's different than everyone else. Everyone has a different financial fingerprint. And so the biggest concern that I have is, you should not be changing your risk tolerance whether the markets are up or down. It should be consistent. And so then when you come in and look at your accounts, we can say, okay, it is up or it's down, but it's within the range of comfort that you have. Then we can say, okay, the existing money, what are we doing about that? That is where we're weeding the garden. And I use that term kind of loosely, but the idea is, when we look at your portfolio, is there anything in there that has performed worse than we thought it should? Not that it's not down. It's just that it do what it should have done. And if it hasn't done that, we should weed the garden, pull it out and put the next best in. And then on the other side of things, with new money coming in, I don't know that anybody would argue this is like the buying season of a decade or two. I mean, we will not see opportunity like this very often. So with new funds coming in, yeah, we should be taking advantage of these low prices because they are there. I mean, no one, I don't think, would dispute that. So the question really then becomes is, how long will it last? That's the challenge. So in my mind, make sure, I try to emphasize this with everyone, make sure you're polarizing, meaning make sure you have enough cash on hand if this is prolonged or it's longer than we thought or things are going to get rough, that you have what you need, that you don't disrupt your long-term money. And then long-term, yeah, you can afford to be a little more buying into the stock side of things while things are inexpensive.
Okay, so I want to pick that up. So March 23rd, we're thinking right now, that's the low point. Right now, that is the low point as of this recording. And from March 23rd until April 15th today, the market has jumped nearly 25%. So my question for you, John, you have this emotional cycle, which is tied to the investment life cycle. So as the market comes back up, like we saw from March 23rd to April 15-ish, you have this tremendous optimism. Maybe this is getting better. Or enthusiasm. We're seeing clients' personalities come out because of the stress of the environment. Some are greedy, some are fearful. Nothing wrong with either of them. We get to the emotional cycle of euphoria. It's never going to go down. It's fantastic. And then all of a sudden the market dips. And maybe you felt like, I was a little overconfident. Maybe let's reposition. Let's get back to the fundamentals. You did a great discussion on fundamentals there. Then it keeps falling. There's anxiety. Where's the bottom? Then we kind of run into denial. This is where the investors, they're ignoring all the warning signs and, whatever. It's never going to come back again. Investing is gambling. Finally, we're at panic. Let's sell everything. I don't care. The world's going off the charts. I usually say something else there. Where are we at in this life cycle? Emotionally, where are we at? And monetarily, where are we at in today's life cycle of finances?
I do think that you hit a strong point, and that is that emotionally we go through these stages. It's almost like the stages of grief. I mean, where
Totally.
you see people coming in, and right now, one of the common elements right now, we went from that high to low, and first it's the shock and awe of, oh my gosh, what has happened? Look at my accounts. And people are getting their quarterly statements now,
Yeah.
and they're now seeing the numbers, and that's hard. And even now, from the quarterly statement to today, it's like 10% higher than that. And so it's amazing how fast and how much you have to, adjust to that. Now,
I want to call it that point though. That statement, again, March 23rd was our all-time low this year.
yeah, and the
that statement
31st
came
is
out
your
on
statement.
The 31st. And then
Yeah.
from the 23rd until today, you're up 25%. So continue with your thought there.
So so when we see that, I mean, you get the first is the anger and denial, and let me that point in the stage of the cycle is the most dangerous, because I'll ask our audience as well as you, when have you made the worst decisions of your life? What emotions were you feeling?
Our audience isn't going to respond, so I guess I will.
Yeah.
Fear.
And anger, right?
there it
when
is.
you're mad, think about with your kids. The worst time you're the worst parent is usually when you're mad.
Yep.
And the other thing in investing, fear. And so that's where, our role is critically important. I have tried to make myself, and you've tried to make yourself very available, because this is when people need perspective.
I don't know if you know this. I've been very available because the governor won't let me travel anywhere. So, yes, I'm very available right now.
Well, thanks to the governor,
Yeah.
All of our clients
Call
are
me
good.
anytime.
Anyway, so in that cycle, where we hit the first of all, that fear and anger stage, then the next stage to me is acceptance. Okay, this is where we are. Okay, it's bad, but what we can do something. Now the interesting thing to me is, in the past, now I've been doing this for a few years, you've been doing this for a few years. In the past, the transition between those 2 points was kind of long. In today's, I felt like as I've discussed it with people have moved to that second stage of, okay, what do we do now? A lot quicker. And I wonder if part of that is either the speed of the drop, and so people are hoping for a quicker recovery, or it's some like PTSD from 2008. Because we went through this not that long ago.
Right.
We really
Right.
have had some pretty rough cycles in the most recent past.
Well, let me argue a third scenario.
Yeah.
We're all this isn't a financial crisis yet. Put the quotes around yet. It's not a financial crisis yet. It's a healthcare crisis. And so unlike 2008, which was a financial crisis, unlike 2001, which was a financial crisis, unlike 1997, which was a financial crisis, people are looking at this saying, I may not understand how long this will go or the economic implications of it, but I understand why it's happening. The governor told you to stay home, so you can't go to work. So you're not earning money, so you're not spending money, and we're all sheltering in place.
Yeah. I also think there's an element of none of this matters until the public health issue is addressed, and that's a global issue. It is a little bit of a binding force across the world. We're all fighting the same enemy. And so in some ways, I think that people are saying, okay, this is something that we're going to get past and we're going to accomplish together. That's a good thing. The hard part is, going back to a little bit what I said before, is we have no data yet. I mean, we have no information yet, and we're just heading the earnings season. It could be pretty rough still, and we just don't know it yet.
There's a great screenshot traveling around the internet right now where a CNBC host is talking about how horrible the market is, how horrible this all is. And there's 2 captions on the screen. One is the jobs report, which is 16 million people lost their jobs since this began. And the other is the stock market hits this all-time high. So this dichotomy between the two right now, how do you break that down? What does that mean? The stock markets are going up. Everybody's losing their job. What are we to read into that in the market?
Well, I think part of it is we don't know. I mean, we really have to start looking at what is the long-term implication of a GDP drop, which we know is coming, with unemployment. And now with the payroll protection plan, that's a whole nother element of this, which we probably won't go into that deep, but it's intended to help preserve jobs. I mean, that's the whole intent behind it. And so it's to give companies enough money to keep people on the payroll, to try to stem the tide of all this unemployment that is happening. I mean, I've got clients that have actually shut down their business until they can go back to work again. And that is just devastating. And how do you keep people employed if you can't even see a client? And that's several businesses. So that's a hard part because that payroll protection plan only helps those that keep employees. Well, how do you keep employees if you can't even serve anyone? So that's one of the challenges. Is we look at that in the long term, we don't know really yet what the impact of being shut down for a month across our entire economy is going to mean. We know it's going to be bad. The question is, with the market being down 20-25%, is that representative of what's happening, or is it not enough, or is it too dramatic?
So let's pick that up. We don't know what we don't know. So all we can do is look at trends and look at history. And, one thing that didn't make it in last month's podcast with Robert Spendlove was we had a behind the scenes conversation, and he says, how deep do you think this will go? And I think you said to him, that's the wrong question. That's not what we're asking. Not how deep will it go. It's how long will it go? Let's talk about bear markets and how long they go. And are we in a bear market? There's 3 types of recoveries that I hear people talking about. There is the V shape. All the economists that are really optimistic, all the government types, they're promoting the V shape. It's a fast down, it's a fast back up. Yeah. There's what I consider more astute economists saying, maybe it's not a V shape. Maybe it's a W shape. Maybe it's, first drop is the healthcare drop, second drop is the financial drop, and then we come back out. Yeah. And then there's the one we're all afraid of, which is the L-shaped recovery, which is it dropped and then it went horizontal. Where are we at, and what do you think is happening?
Yeah, I think that probably we're going to see more of the W, in my opinion, and it may be more like, instead of sharp up and sharp down, it may be more U-shaped. And so I think that's very probable, because I don't think we've had the healthcare side first. The economic side, realize that the stimulus is going to stimulate. It is going to move the economy back up. Keep in mind, the one thing that no one is discussing, not much, is we just added $2 trillion to our debt in a week or two. And right. That makes me a little concerned. And granted, we've had very low inflation for a decade and a half. And now we've just added a ton of money into the system. Now, in a simple term, if you have a lot of money chasing very few goods, people are going to charge more. That's inflation. Costs go up. So will that happen? I don't know it will in the short run. In the long run, yeah, I'm very, very concerned about what that's going to do to national debt, as well as the inflation rates. Despite that, even in inflationary periods, you look at the history of the markets. That graphic that we'll maybe share later, but if you go back to 1935, the S&P 500 has grown 25,290%.
That's a hard number to conceptualize.
Yeah. So the better way to look at that is, in my opinion, is look at the number of times it's down versus the times it's up. So if you take the total number of days in that period of time, you were up 4,563 days, and you were down 1,094 days.
So a 1-to-4 ratio. 4
times as often up.
Right.
So, and think of all the things that have happened. Granted, this is a terrible crisis. It's not World War II. At least I don't think it is. It's not, the Great Depression. That was actually prior to this data. We've had so many of these crises, and we will have more. Very often people say, well, gosh, this came as such a surprise. Well, so was 2008. So was the dot-com bubble of 2000. That each one is unique and different from the last, and it never is the same thing. And so the point to be taken there is make sure that you understand that the markets will cycle, and there is volatility. And we've kind of gotten to the mindset where we think, oh, we just want it to be this nice gradual rise over time. It just feels better. Well, that's just not how it works. And so when we see these downturns, that's when little things like things that have gone out of favor a little bit in the prior years, diversification. I remember seeing article after article about diversification's kind of dead. It just doesn't make that much difference anymore. You don't hear anybody saying that now. Now it is very much in vogue. The other thing was things like, the modern portfolio theory. That's kind of the foundation of all financial planning. Well, the 2 elements you cannot extract from that throw the whole thing off is that it assumes that markets are efficient. Okay, everyone take a look around. Markets are not efficient. And the second element is that people will act in a rational manner. No, they won't. We are emotional beings. And so until we can extract those two elements, modern portfolio theory is a great guide, but it is not a law. It does not work perfectly. And so that's part of it, is just making sure that we're realistic about the world we live in investing, especially. It's a messy world. So we want to make sure that you have a foundation first that's not messy. Make sure you have, the things that eliminate the big risks, basic insurances, cash on hand. Those are critical to the base so that you don't disturb the things that have to go through the volatility to make you grow at a reasonable rate.
So lots of good data points today. We talk a little bit about market cycles. Maybe every 4 years you have one bad one. Maybe that's the 4-to-1 ratio. We talk about emotions of investing and how they seem to follow investing cycles as well. We talked a little bit about the unknowns. We have lots of unknowns right now in this whole thing.
Yeah.
What are the big takeaways? What should people put a pin in and say, this is important to me?
Yeah, I think that when you, at the end of this whole discussion, the bottom line is, how does it apply to me? In other words, what does it do to my money, my portfolio? And remember, the money is not a good or bad. It is not what money is, it's what it does. Is it going to accomplish your objectives? Every one of my clients, they have a different financial fingerprint. They have a different set of priorities. I bet most of my clients have heard me say at some point, if you look back over the last couple of years and said, that was like a perfect period of time, what would make you say that? I'm sure that many that are listening have heard me ask you that question. And so you've got to look at it and say, with the unknowns that we have, what do we do to say, how do we take advantage and how do we protect? And always start with defense first, and then worry about, hey, how do we take advantage of what's going on? There will be incredible opportunities in the next few months, but those only matter if you're in a stable position first. So that's kind of, to me, is the takeaway, is to make sure you're assessing consistently, okay, a month later, am I still in a stable spot with my safe money and what I need for the next little while? Then start looking at, okay, now, who do I buy? Who is attractive right now? And that's the approach I would take to it.
Wonderful. Well, we're wrapping up now here with John Mickelson. Some great advice. I'm Patrick Jenkins. We are Wealth Advocates. Grateful that you listened to us today. Hope you found some value in our conversation. And if you'd like to discuss more, please reach out to us at 435-754-7888. Otherwise, have a fantastic day.
Thank you for listening to the Wealth Advocates. Join us every month by subscribing on Apple Podcasts, Spotify, or Google Podcasts. You can also look for The Wealth Advocates on Stitcher and YouTube. Want more information about today's topics? Reach out to John or Patrick directly by calling or texting the Wealth Advocates office at 435-754-7888. Learn more about the Wealth Advocates and how they can help you by visiting www.wealth-advocates.com. Securities offered through registered representatives of Cambridge Investment Research Incorporated, a broker-dealer member FINRA SIPC. Advisory services offered through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Wealth Advocates and Cambridge Investment Research Incorporated are not affiliated.